Okay, after that great introductory session, it is my pleasure to be able to take this one step forward. And let me quickly introduce the panel, and then I'm going to try and set some definitional agenda so we can probe a little bit further. So first of all, Bill on my left. Bill gave Adrian's background. He didn't give his own. Bill, as you know, he's chair of the Bretton Woods Committee. He's co-chair of this Future Finance Work Group. But his claim to fame is that he was the president and chief executive officer of the Federal Reserve Bank of New York for 10 long years, perhaps longer than that, from 2009 to 2018. He was also vice chair of the Open Markets Committee. And so he had an active hand to play in setting up monetary policy in the US. And if at the fag end of this thing I get a quick minute, I'm going to ask him the question which everybody's more interested in right now. So, you know, he's actually, before he became a regulator, he was on the dark side. So he worked with Goldman Sachs for a long period of time and as a chief economist. So that's Bill. Let me go to Seri, Dr. Chia Seri. She's Assistant Governor and Director General of Central Bank Banking at the National Bank of Cambodia. She is a vocal proponent for the greater use of the local currency. So Cambodia was a dollarized economy. And I think through her singular efforts, they've been able to switch that and get a much bigger role to play for the Cambodian real. In the process, she launched this whole national system in Cambodia called the Bakong, which is effectively a digitization of the local currency. And it's been fantastic. It's been tremendous success. It got actually finally launched 2 years ago. And in 2 years, it's just completely taken over that country. And so I call her the queen of Bakong. But thank you for joining us, Seri. Your experiences in that regard, your thinking around it, that would be really helpful. And then finally on the left is Ravi Shankar. He's the Deputy Governor at the Reserve Bank of India. He's also a career central banker. And you know, he's worked in a lot of different positions. But you know, he's got expertise in exchange rate management, reserves portfolio management, public debt management, monetary policy, regulation, surveillance, a bunch of things. But in recent years, he's really been the front and centerpiece, the spokesman for the RBI in terms of thinking about some of the issues around digital assets, financial assets, and cryptocurrency. So I couldn't have looked for a more appropriate panel to be able to help me set the stage on this. Okay, here's how I want to do this, you know, just to make sure we get some ground rules. It seems to me all the time, there's, you know, Adrian just spoke about getting taxonomy right in a different context. I think we just need to try and set some understanding of taxonomy so we're all talking the same thing. So the first thing I'm just going to define, and this is my own arbitrary definition, is when we talk about a digital asset ecosystem, we are talking about effectively a tokenized representation of any source or resource. It's a broad definition. So you can tokenize and have a tokenized resource. And fundamentally, I think it's got 2 or 3 characteristics, right? So one, it is on the blockchain, which means instead of point to point, instead of hub and spoke and intermediated, you can go point to point. And so that's one big distinction. Second is because tokenized, you can actually fractionalize it. So, you know, you can get to decimals of ownership. And I guess the third key thing is actually it is programmable. Because it is atomic settlement point to point. You can build little programs into when do you want something to happen, under what conditions will it happen. So I loosely define that as the world of digital assets. It's everything. Now, within that, the second definition thing gets a little bit more tricky, but here's how I want to frame it, right? There's what I call public digital assets, and particularly it is digitized versions of fiat money. I call it public assets because it really takes a digital form, it takes a fiat currency, it takes a national thing, and gives it these characteristics. Put it on blockchain, you know, create point to point, maybe put some programming around it. I would argue CBDC is also in the same realm, whether it's a digitized version of fiat or it's a CBDC. It is still fiat, it is backed by the imprimatur of the state. And so I'll put them all in the category of public assets. And the second is what I think of as private assets. Now, private assets themselves, I sort of categorize into 3 or 4. So we've talked about all of them in the morning, but at the one extent, say private assets would include the digitalization of existing forms, securities, for example. You know, digitized security, digitized equity, digitized fixed income. You could even extend it to digitizing art, money, etc. But there are those kinds of, you know, a digital representation of assets that exist today. Second piece of that would be digital representation of new things, NFTs. So utility tokens, or it's like almost like airline miles. You digitize stuff of that sort. But then the third and fourth category, you start getting closer to the realms of money. So the third I would put in the category stablecoin, which is effectively a bridge, as you said, Bill. It's a digital representation that's privately issued, but has a link back into some official domain to try and give it some value. And then the fourth is obviously crypto coins. And I want to do this so everybody doesn't mix up the conversation. To me, crypto coins are a great example of a private asset, private money. Right? And so if you think about the world today, I think half the challenges are, is the technology good? Can the technology be used? And can the technology be used for public assets? It's a different question from, is there a role for private money? Right? And how do you see a role for private money in this big scheme of things? So if you're okay with that broad definition set, I'm going to start this thing first with focusing the first part of the conversation on the public side, the public assets thinking. And so the first question I will ask, I'm going to start going from here, Bill, all the way down. You just said in the last session that obviously the technology is interesting. But why is the technology interesting? Is there a role for these digitized public money or fiat currency, or a role for CBDC? And what, if at all, is that role, and how should regulators be thinking about it? And then I'm going to ask Siri to talk a little bit about Bakong, how you thought about it when you rolled it out. And then more recently, I think RBI has also made some announcements, so we will get to that. But when we start with you, Bill.
So I think the technology is interesting for a number of reasons. For one, you don't have this question of like who actually owns something. Only one person can own something on the blockchain at a time, right? And so you can imagine for things like trade finance, cross-border payments, security settlement, that all that can be very, very useful to have that notion of this is owned by X, and we don't have to worry about disputing about who actually has ownership. So that's one thing. The second thing is decentralization, and the fact that you can sort of do it across the world sort of instantaneously. So, you can presumably move money with this new technology cross border, and presumably when we finally work this all out at a much lower cost than the current regime. Right now, it costs anywhere from 3 to 6% to take a transaction for the United States. Say a migrant worker sending money back to their family at home. That's an awfully lot of breakage. And it seems to me like you could reduce that dramatically. So I think there's a bunch of possibilities. And also I think just the fact that it's a different technology may help you reimagine how you set up financial intermediaries and how they interact with their customers. I mean, right now we have these very big, large organizations that run sort of these legacy technologies, batch, very cumbersome, very hard to update. I think the technology also may turn out to be much more nimble because you can start to introduce version 2.0, 3.0, 4.0 very, very quickly. And so that you may see much more rapid improvements in the technology. I mean, right now, for the existing infrastructure, if you try to change something, it's extraordinarily difficult. And as Adrian knows, for smaller institutions, it's almost impossible. Very small banking institutions in the US are essentially locked into their service providers on 3 to 5 year contracts. So it's almost impossible for them to migrate from the old technology to the new technology, even if they wanted to.
So if I sort of pull out from that, I think Adrian mentioned it earlier. So one is inclusion. It allows broader inclusion. And the second, Sheila Bair mentioned it at the financial conference, says that the industry is controlled by oligopolies and big banks, and maybe we can do away with them and distribute power, classic Sheila Bair. The third, that it can make cross-border payments better. Though I'll push that. The bulk of the cost in cross-border payments is a currency cost. It's not a payment cost. And the currency cost only disappears if you have a single currency. And as long as you don't have a single currency, it's harder to be able to get that, or at least a settlement process which takes care of the single currency issue. And I guess this thing about everybody knows everything. Again, the paper that you did with Caroline Wilkes, she wrote about it, it's actually not the straightforward. It's not as decentralized as you might think it is. The few numbers of validators and few number of protocol writers who really have a lot of control on the system. But the underlying thesis is that it can allow all of these things to happen, so it's probably a good thing. Right? Do you share that view, Seri? And I guess some of it you do, which is why you pushed ahead with Bakong. You want to tell us about your thinking and a little bit about Bakong for the
Well,
audience?
thank you, Piyush, for having me. I feel so small in between these gentlemen. But I'll try to put this technological concept into context because I don't have a tech background. I have an accounting background, turned economist, and somehow within this week, sometimes do a blockchain expert. So when we started, I think the beauty about this digital asset is the peer-to-peer and the programmability that you mentioned. Now, I want to put into context the peer-to-peer. When we embarked on this project, the issue that we wanted to address was the interoperability between the different players in the market. We have the payment service provider and the microfinance who operate and regulate as a technology provider, and then we have the commercial bank. The commercial bank are connected to the National Clearinghouse, which is a centralized system, and then you've got the rest. And so these different groups don't talk to each other. They don't even talk to each other, but then across the type of institution, they don't either. And so one way we could do it is to bring the payment service provider and the microfinance into the National Clearinghouse, in which case they will have to comply with the liquidity management as we would normally require from banks. And that's a lot. You have to have a settlement account, you have to have a credit facility with the central bank. And that would actually beat the purpose of regulating them as a technology provider in the first place, because you add on the burden of compliance. And so we thought of bringing the peer-to-peer, the blockchain part, where they don't have to be in the system, they don't have to comply with all this liquidity issue. All they need to do is to be able to issue this form of digital money to their client, and their client, if they have money, they can send. If they don't, they can't. So the payment service provider don't have to worry about the settlement part. And also because it's a common platform, we were able to bring everyone together. So what we were able to address, and here putting you in context, is that we connect the rural area who mostly use the wallet, so the payment service provider, and the urban people together. Previously, if the people in the urban area want to send money back to people in the rural area and vice versa, it will be very costly. And I don't even mention about cross-border, right? And there's a personal reason for me as well to do this, because the mother of the child that I adopted, my youngest boy, was a migrant worker. And every time she sent money home, the money got abused by the alcoholic father and brother who was a drug addict, and the mother got beaten. And when she was no longer in a position to work, she went back and she realized that all the money sent was in vain. And so she got very mentally ill, etc., and she got raped and got my boy. And to me, what I wanted to solve is how can we allow these migrant workers to send money home on a peer-to-peer without having to worry? Because when you send money home,
this is within Cambodia still.
It's within Cambodia. So when you send money home, there's actually a fixed fee that you pay, and also the percentage fee. And the percentage fee is fine because it's whatever much you send. But the fixed cost is a lot, because the more you send, the more you pay. And by allowing this peer-to-peer, what happened is the migrant worker can now send money home directly to the hospital, directly to the school, without having to bypass a family member who possibly could abuse this money. So that's just to put you in context why I like this idea of peer-to-peer and do away from intermediaries. And if you think of it as a cross-border potential, you can actually settle local currency, and that is really beautiful. The other things that I like about programmability, in fact, Cambodia just issued our first government bond on blockchain technology. We have a trading platform on blockchain, and recently we issued the government bond. And what I like about this is the payment versus delivery part, where we can do away from custodian banks and all these fees that are in between. And if you sort of look at it much further, is you are now really democratizing the capital markets, where if I only have, and the fact that you can also break it into smaller denomination is beautiful, because if I have $10 and I want to invest in government bonds and the money will go to a green project or hospital or whatever, I can contribute. I don't have to be a big investor to be part of the bigger initiative.
I mean, to take you up on that cross-border piece. So when I asked you, within Cambodia, it obviously works. Urban, rural, the payment service provider, the clearing system, it's all in a single currency. You've also done a couple with Thailand and Malaysia. Is there a currency conversion involved? Are people, because surely people in Thailand and Malaysia are not happy holding Cambodian reals. How does that work?
So the things that we did with Malaysia and Thailand is not purely on a blockchain. So for the cross-border part, it was still the conventional, but the moment it go into Cambodia, it's all blockchain distributed. We are currently exploring with Laos and Vietnam to see how we can use this blockchain technology where each country will create their own currency, and every time a customer of a bank send money, the bank itself, the individual bank, will do the conversion. We don't need a central foreign exchange bank. Each individual bank will have to take care of their own customer. And then the commercial bank will send message to the central bank or the payment gateway and say, send Sing dollars to Singapore. And with the programmability and the traditional way of doing it is you send a message and then the money come. But with peer-to-peer, you send a message and you send the money across the border right away.
Understand. So hold that thought, because I'm going to come back and push that argument. My view, when I talk about public and private, one of the big issues in this space is really this, that a number of people, I'm going to come back to you, Rabi, because RBI has articulated it well. Either you believe in the Westphalian system, the role of the government, the role of the state, the role of institutions, and therefore the role of national monetary policy. In which case you want to make sure I run my currency accounts, and I have the levers of economic control. And therefore when I pay Malaysia or Thailand, there is still a conversion to their currency, quote unquote. In your example, there is still some bank who's going to do the conversion from real to, the etc. The evangelists of this world would argue you can have effectively a global currency. Right? The crypto, when I said in the private side, my extreme example is crypto. I can use Bitcoin, I can use Ether, I can use that to settle everything around the world. And therefore I can create a currency construct, which is like the old Esperanto in the 1960s. It's a global currency. And therefore it keeps outside the realms of nation states, the Westphalian system and central bank. But it does and gives you the same kind of benefits you talked about. Instant settlement, immediacy, gets over cross-border hurdles, gets over exchange. But it comes with its sets of challenges, because it challenges the construct of the world we know today, which is the Westphalian construct of the world. So I'm going to come back to that when I get to the private side of the discussion. But meantime, Rabi, to you. So RBI just launched the wholesale, this thing on CBDC, I think in November. And you got some prospect of doing retail coming up soon. But more important, you issued a paper on CBDCs in October, which got a lot of attention. And some crypto players on what I call the evangelists said basically you're trying to create a monopoly on fiat money, which I thought was the point. You are trying to create a monopoly on fiat money. So what is your view on this public side? Is it worth it? Why are you trying to do what you're doing? And what are the problems, if you see, if any?
Fiat is monopoly, I guess. But no, I like your division of products into CBDCs, NFTs, stable coins, and crypto coins. That sort of classifies them well. But I think we need to make a distinction between the technology aspects of it. For example, what Bill highlighted about blockchains, about tokenization, about programmability. These are all technology aspects. They don't necessarily require or involve digital cash. And very often, more often than not, these are mixed up. And this is where I'll come to CBDC. Why CBDC can or a central bank fiat digital currency can play a role. The movement for digital cash, as most of us would know, is far older than Bitcoin or cryptocurrency, which is barely a decade old. I think this was sometime in the late 80s, maybe 88 or something, when the Crypto Anarchist Manifesto of Timothy May came out. I remember the first line of it, not much of the later, because it rhymes with some other manifesto. It says a scepter is haunting the modern world, the scepter of crypto anarchy. That's where it starts from. So that's the philosophy, that's the ideology of digital cash, that cash should not be issued by fiat. Now that's a different ideology, that's an ideology in itself, that's a philosophy in itself. One can go discussing about that. So I'm just keeping that away and making that distinction that a technology which enabled pseudonymizing money can also be used for any other purposes. Money is not central to it. Now, if money is not central to it and money needs to be digitized, I don't mean money, I actually mean currency, cash. Money is already digitized in terms of bank deposits. So I'm talking, if that needs to be digitized, what is a situation that seems stable? Potentially n number of private currencies, or potentially one fiat currency with which all of us are used to. Whenever we talk about private currencies, cryptocurrencies, we talk as if there is one. So this argument is very often given that it has a limited supply. One currency might have a limited supply. And even that one currency doesn't quite answer what happens when that supply runs out. They say we will see it when we get to that, maybe another 20, 30 years. But that's not the way you would want some change to happen if you are not clear about the end, the end game that you have in mind. So, do you want so many currencies? Is that a recipe for confusion, if not worse? Or do you want the benefits of the technology, tokenization or blockchains or programmability, and use the fiat currency in a digital form? Now, for me, the answer is very clear. For me, the answer is very clear. And to be honest, I haven't come across even one single argument why the answer can be otherwise. There is this tendency to compare cryptocurrencies to gold. Gold is one of the 91, 92 naturally made, commonly found elements. You can't compare that with one coin which has a limited supply. Just by calling it mining, when you mine a cryptocurrency, you create your own mine. Now, gold, you don't create your own mine and then mine gold. You see, so comparing these things to gold to me seems a bit of a joke. So keeping all that in mind and keeping the fact that there are clear benefits of the technology, potential benefits, because the actual benefits in terms of achieving scale, in terms of achieving cost efficiency is not very clear to me, but I'm no expert in technology. Maybe we'll achieve that soon. Maybe we already have it. But in any case, to the extent the technology exists, it has value and we can use that value. And we can do that with far less concerns about instability in the system if we use a central bank digital currency. Now, coming back to what we have done, that is the thought behind our focusing on CBDCs. So what we are thinking is that let's provide a digital currency, a digital rupee. Let the users, let the consumers decide for themselves whether they want this, whether they want a bank deposit in digital form, or whether they want anything else. It's a consumer choice that they will make. But since I'm convinced that there is no use case that a private currency can provide, private digital currency can provide, that a fiat digital currency cannot, let people then take that call and make their choices. So we are basically providing it. The benefits are very clear. I think Bill has identified them, cross-border, and I don't quite, pardon me, if I may differ with you, I don't quite agree that a large part of the cost of 6% that World Bank has worked out for cross-border transactions is exchange, because exchange doesn't move on an average over history. It doesn't move more than 30, 40 basis points a day, 50 basis points a day on an average. So 3.5% that my credit card charges for my conversion rates are too high, but that's another issue. So exchange is not the major part of it, and technology can actually provide us the benefit of, substantially reducing cross-border costs, transaction costs, and transaction efficiency, the time taken to do that. I can easily foresee an instantaneous cross-border transaction, just like we have UPI transactions at home. It's instantaneous for the average user. I can see that happening in the cross-border space as well. So that is the biggest advantage. I think the next advantage, which we haven't focused on enough, is the huge amount of capital and liquidity that banks and other intermediaries today spend for settlement risk. Now, if you settle using central bank currency, it's as if you're settling by handing over cash. Now, you take care of a substantial portion of this settlement risk, free up liquidity, free up capital for other purposes. I think this is another point that we need to focus on. I'll stop there and probably take it.
We talk after this.
Yes.
But actually, Singapore does a lot of this. So we do both the DVP example, which we just launched with Project Guardian, and with Project Ubin, the instant settlement of currency. By the way, again, we'll talk after this. When you tokenize digital currency, you need to make sure the money is there before you tokenize it. So you don't get as much settlement benefit as you think you do. Because in settlement T+2, you're holding the money after the transaction. Here, you're holding it before the transaction to tokenize it in the first place. So we can talk about that. But I have a question for both of you, Seri and Listen. I asked you offline. You digitized, you created the digital bakong thing. How do you see this different from CBDCs? Because you've said in the past that, whether you call it a digital version of the real or a CBDC, you can call it what you want. I know what it does. But do you really see it as different, and how do you see it as different?
So when we first started to present our management at different generations than my generations, and mind you, this was in 2017, 16, and the first question is, what is blockchain? Nobody heard about it, and we were very sort of excited about it. We say it's a new technology. And then the question was like, who created it? Who bring it forward? And we say, this is an anonymous guy. And at that moment, I knew I get on the wrong foot with the management, and I have to step back and go and study about it again. So the good thing also, because I'm not a technologist, I tend to be very naive. I know what I want, I know what I don't, and I will let the technologists handle it. Now, with Bakong, I think the way it differs from a CBDC, and again, I don't like to sort of label things, because at the end of the day, it's what do you want to use it for, right? And for us, it's mostly for payment, so we call it a backbone payment system. What differs from the conventional sort of definitions of CBDC is the liability on the central bank. I think that's one of the main issues that we differ. We distribute this currency, so banks will have to exchange fiat money with the central bank, and we do both in US dollar, and because we are a dollarized economy, in our local currency, and then we keep this money, we manage it, and the banks are the one responsible to distribute it to the end user. We don't hold, so the liability on the individual are not on the central bank balance sheets. That's a very important distinction, I think, from the regular CBDC. It is not a token-based, it's an account-based, so we can do wallet to account, wallet to wallet. I think that's the two main, and then there's other anonymity and etc. Central bank don't do the KYC on the customer when they download the central bank e-wallet. The banks are assigned to do it on our behalf. And I think that really is a choice, because we didn't think we want to know too much. We don't think that the public would want us to know too much about their transactions, but the banks already know what they're doing, so we may as well pass the responsibility to the commercial banks. And I think we can do whatever we want, and we don't have to stick on that particular taxonomies or whatever. I was criticized about the project Bakong, and somebody asked, a techie guy, come and say, oh, but you said this is blockchain, but it's not even on a public blockchain. So what's the purpose of using blockchain? I said, I don't care if it's public or it's closed loop or it's private. All I need is for it to serve its purpose of doing peer-to-peer, and the rest of it, it's up to me to design it. Also, we designed the liability part. I mean, from a technology perspective, because it's on the wallet, nobody else can actually take the money from you. But we designed the code of conduct, the rule and procedure in such a way that if the bank with whom I registered myself with go bankrupt and the provisional administrator need to do consolidation of the asset, we can actually block that transaction. Even though the money is in my wallet, the central bank can actually block and let the provisional administrator liquidate it to do their job properly. And that's a very important distinction from the regular CBDC where you compare it to cash, and once it's in your wallet, it's yours, nobody can take it. So it's just a matter of
Ravi,
design.
I'm going to take you. So as you think about the retail CBDC, I mean, another way to define what Say talked about is intermediated versus non-intermediated CBDC issuance. So non-intermediated, central bank opens effectively a digital account for every citizen in the country and you hold currency. The intermediated is you go through the existing financial system and you let banks do the conversion from account to wallet and token. Have you given it thought, and did you come to specific choices?
Yes, in fact, we've thought quite a lot about it, and then decided to avoid, central bank opening wallets for the entire population, and going forward, maybe even hold us outside the country. So we followed a design that we follow for actual cash, physical cash, which is that the cash comes from the printing press to the central bank. We give them to the banks, and the banks distribute that cash. We followed exactly the same model. In fact, a lot of questions that arose, questions like this, questions like, how is it different from cash and so on. We follow a simple principle that we want it to be as close to physical cash as possible, as technologically possible. Anonymity is an issue. We want to be exactly as anonymous as physical cash. Now that's not very easy when it's digital. I don't even know whether that's eventually entirely possible, but I'm told it is technologically. Legally, we can make that possible. We can get some degree of anonymity. And similarly, in terms of liability, it's a central bank liability. So, for example, one of the models we are looking at, and in these pilots, the wholesale one we started on the 1st of November was an account-based one. The retail one we are planning towards the end of this month would be a token-based one. That will be retail. One of our objectives is to try out various possible combinations, various possible technologies in these pilots, and try and find out which works best for us. So it's not something that we have already decided, but it's something that we are in the process of experiencing and deciding. Apart from the fact that we want to learn, how it affects customer behavior, how it affects bank deposits, how it affects other things. There is no experience anywhere in the world for us to actually take to. In this context, which is why it was very easy for us to decide whether or not we would have the CBDC should pay interest. We want it to be like cash, and cash doesn't pay interest. So it was very clear in our minds that it is cash, it is currency in circulation on the liability side of the central bank's balance sheet.
So, Bill, I'm going to bring you in the conversation. If you look at the gist of both the Asian regulators, they're basically saying don't see a real role for private money, but if you can use the technology to digitize public money, it helps. Actually, Ravi Menon, our central bank head, has written about this a couple of times as well, in the same vein, saying we want to experiment on being able to do all of these things, but he's also highlighted other risks of a retail CBDC regime, right? In a crisis, does all the money move to the central bank? Is the central bank responsible for credit creation if you disintermediate the commercial banking system, etc.? However, from your opening conversation with Adrian here, you guys seem to be thinking about it slightly differently. And your general approach seems to be, let's not stifle innovation, let the crypto guys get on and create these new currencies, and we'll put some appropriate regulations around them, whether it's disclosure standards, whether it's suitability standards, whether it's capital equity standards. But we can sort of ring fence this and corral it, but let them thrive within that system, right? And that's a different sort of message I'm hearing from the regulators over here. What do you think I've got it right? Is there really a difference, or am I missing the point somewhere? And if there is, what do you think drives this difference in thinking?
Yeah, I don't think I'm knowledgeable enough to tell you how big the difference in thinking is. I mean, I think where I come out, and I think Adrian's probably on the same page, but is that we have this interesting technology that does things in a very different way. It could potentially have lots of benefits, but right now we have sort of the Wild West, and there's lots of scams and rip-offs, and that's not a great path to go down. So what I think I want is that I want a regulatory regime that's focused on outcomes. So basically, here are the outcomes that we want to achieve. We want to be able to protect people. We want people to actually have security in their accounts. We want people to have trust in the system. But we're not, but pretty agnostic about how you actually would accomplish that. So in other words, don't just take the old regulatory structure and pass it over to the new regime, but basically talk to the innovators and say, here's what we need to accomplish in terms of outcomes. How would you do that in our regimes? What kind of regulations could make the outcomes consistent? There's a very strong precedent for this. Following the great financial crisis, we decided to put a lot more eggs in the basket of central clearing counterparties, CCPs, and we recognized that if we're going to clear all this stuff centrally, boy, we need to make sure that these entities were very robust. And so what we did at the international level is we actually did a whole project on principles for financial market infrastructures. In other words, what outcomes should a financial market infrastructure be able to achieve? And we didn't tell people how to achieve it. We basically took those PFMIs and basically said it's to each individual country to figure out how to apply these goals in their current regime. And the IMF actually followed up and did audits of countries to sort of see how well they were doing. And I have to say, so far the experiments worked pretty well. We put a lot of eggs in the CCP basket. We've gone through a lot of stress through the pandemic, and the CCPs have performed pretty well. So it seems like a good approach for the new regime. So the point is to focus on outcomes, not on just taking over the existing regulations. But to do that, you have to have the firms that you're regulating want to understand the value of the regulation and that this is actually going to lead to a better outcome for them. So that's the challenge. Because there's some people that don't want to be regulated. Let's be very clear about that.
Today, of course, most crypto players are showing up saying, hey, regulate me. But I'm not sure how much they really want to be regulated and by what set of regulations.
Well, it depends what that means, right?
Exactly. All right, I've noticed there were a lot of questions from the audience, but I want to jump quickly to two specific things. If I go to the host of things I defined as private assets, right? I said effectively you could tokenize securities or artwork or buildings. You could tokenize non-fungible tokens, so loyalty tokens, utility tokens, airline miles, if you will, stable coins, and then finally cryptocurrency. So if you can just each of you tell me your take on which of these you'll be open to exploring and which of these you think are really rife with risk. So Ravi, I'll start with you.
Of the four categories, we have already put our choice out there in the public domain. It's CBDCs that we believe.
No, but in the private side. So let's assume CBDC is public.
Yes.
The private security tokenizing of securities and maybe physical.
Yeah, no, I got that. Tokenization of security is probably something we'll try out going forward. We are trying out in the wholesale model, government securities transaction settlements. Next step will be tokenizing securities. Tokenization has its benefits. We have to understand how exactly are they superior to, the dematerialized, digitized identities that securities already have. But that's something we'll try out. NFT is, strictly speaking, outside my beat. Unless something fungible and has cash characteristics, it's a money characteristics.
But I mean, this is what Adrian also said the other day, and I question that.
Yeah.
Because to me, it's a very fine line. The minute you say an NFT is viable, let's take airline miles or Sweet Love Potion or Axie Infinity, and people start trading it. The minute people start exchanging that effectively as a form of value exchange, it starts taking the characteristics of money.
Yeah,
So where do you draw the line?
It's not fungible. That's what is important. You see, even today, you know our views on private money. Even today, you have airline miles. You have specific shops giving their own tokens and all that. We have no problem as long as it's a closed loop transaction.
They're not fungible.
Well, yeah, they're not fungible with others. That probably adds efficiency, and to that extent, yes, private currencies can exist. So NFT is not something that we are focusing at this moment. Stablecoin, the answer actually depends. You look at this stage. You have Bill representing a completely open economy. You have Chip, she has a dollarized economy. You have us, we have our own currency, and we have capital management. We are very different. The way we would look at stable coins is also very different. Remember that the statement I made that I really don't see a stable coin linked to the dollar giving any additional use case that a digital dollar cannot give. I'm yet to be convinced of that. If we keep that in mind, I see what Bill explained about the way they look at these private currency. He's very consistent with what I'm doing. Theirs is an open economy. It doesn't really matter. Everything is linked to the dollar. A stable coin linked to the dollar is as good as dollar. It's just like a bank deposit linked to a dollar. So there's conceptually no difference. A dollarized economy don't carry any additional risks. It's already dollarized. The fear we have, if you, for example, allow a stable coin linked to the dollar in India, is it'll get dollarized. We have a monetary policy. We have a method of implementing policy, economic policy. We can't really be giving all that up for something which the advantages of which are not so obvious.
To me, that's the heart of the problem.
Yeah.
So let's go back to the Westphalian. Any federal, state, central bank, the minute you adopt a global currency or a stable coin linked to some other currency, you give up control of the levers of the economy. And are countries and governments willing to do that? And if they're not, the evangelists again would argue that in the future you're going to have a kingdom of Facebook, and individual kingdoms won't matter. So if you get to that stage, then yes, you can say everybody's on a single currency.
Refer to the crypto anarchist manifesto.
That's also true. Say, what do you think of the four? Would you be okay? Securities already done a securitized bond.
The securitizing of tokenizing of securities we've already done. The cryptocurrency, I think context matter. In the US, probably you're more open because you're very active financial markets and people sort of understand more or less where they are. In Cambodia, you're talking about, the majority of the people, almost the majority of the people not having access to bank account. Capital market is very small. So they're not actually looking for a different class of assets. Like in the US, you invest and you're looking for something that can generate more income. In our case, if anyone invests, it will be like a gambling, and I think that will have to go to the casino regulator. In terms of the NFT, I'm a bit torn as an artist. I'm not sure I want that to happen, but I'm also quite annoyed with my son playing games and buying a lot in the games and not being able to cash out when he stopped playing. So that's in between. And then the stable coin, I think that is something that we can explore, but bearing in mind that the currency to which this anchored to matter, because we already a dollarized economy, and it's complicated a lot the way we do our monetary policy, and I don't want to add on complication to our problem.
So I think the tokenization of securities makes good sense, and I think that's going to happen. The NFT, I don't have a really strong opinion about it. I think stablecoins is interesting because I think you could imagine that it ultimately will just be transitional. It's going to be here for a while, but if the central bank digital currencies develop and have the right technology behind them, I don't think it's sufficient just to have a central bank digital currency if it's operating on the existing technology. I don't think it's going to be very interesting to people because it really has to be able to get into that bridge that new ecosystem. But if you have a central bank digital currency that can actually climb over that divide, then why do I need a stable coin in addition to it? So stable coins could ultimately turn out to be transitional rather than lasting.
All right, I'm going to go to the audience questions. I've got 10, 15 minutes left. So the first one, I'm going to go back to you, Ravi. So I asked Governor Das this question as well. When he said, we should ban all cryptos because of all the AML, KYC, monetary policy issues, etc. So I had two questions for him. So one, can you do it? Do you have the regulatory authority to do it? And second, even if you get the regulatory authority to do it, given that India is one of the most engaged populations the young kids dealing with crypto, and they're all going to Genesis and Binance and see these things and so on, how are you ever going to do it?
You mean ban cryptos?
Yes. If you wanted to ban cryptos, what would you do?
Could you?
Yeah, but, I have actually sort of argued out why a complete prohibition is the only alternative available, for us. And that argument holds even if cryptos did not have any of the negative consequences of AML, CFT, identification, and all those issues, purely from the point of view of policy stability, purely from the point of view of sovereignty, from that perspective. So that has been argued. But I completely realize that, this argument has been made and given in India, and we have argued it across the table among authorities. What's the purpose of banning something which exists in the virtual space? I mean, people just need a computer to do the transaction. Absolutely correct. But if we feel something is harmful, drugs are banned doesn't mean drugs are not available. They are available all over the world, right? So that's not an argument to say that drugs should not be banned. So the fact that you cannot control something is in itself not an argument that you will express your legal view of what it is. So in terms of banning, I do agree. No single country can do it, which is probably the reason why our finance minister has talked very often on the fact that there has to be for something which exists in the virtual space. Regulation cannot be one place, one state, or one country, or anything. This regulation has to be global, not in terms of who is implementing the regulation, but in terms of understanding what are the objectives of regulations, what are the tools of regulations that can happen, and what is the nature of the products that are being regulated. So that is extremely important.
So I'm going to bring you, Bill, because of Bretton Woods. That's the role, right? How do you create international monetary cooperation? As a interesting note, somebody from Europe was once telling me, the Americans' job is to be the innovators. The Asians' job is to be great manufacturers. Our job is to be the referees and be the rule setters. So by and large, the Europeans have excelled at setting the rules for whether it's Basel or for everything else. But as you think about global cooperation, IFI, etc., to set the rules for this new world, how do you think it can happen? Who could take the lead? Is there a forum? Is there an apparatus? Both the Indian finance minister, actually the Prime Minister in India also made the same comment about you need a global architecture for this. Is there any thinking for how this could be achieved?
Well, it's difficult for sure. Financial Stability Board is probably the place where you would start, because that's the broadest grouping of people who are focused on these kind of issues. Another place which I think is going to be very important is the Committee on Payments and Market Infrastructures, which is a BIS committee. I actually chaired it for a while. And that was the committee that with IOSCO did all this work on the principles for financial market infrastructure. So that's a possibility. The problem with all this stuff, though, it's all by consensus. So you can only go as far as the least inclined person. And so it's going to be very hard to drive the process quickly because of it's consensus driven, and it's also going to be very, very hard to drive it to a pretty sound outcome because it's consensus driven. So I think it's going to be very difficult. I mean, look, I think the reality is, if the U.S. could get their act together and do it well, that'd be a good start, because the dollar is a reserve currency of the world. And if you think about all the crypto activity around the world, I would bet when you added it all up, 90% of it's probably dollar-based in some respect.
Yeah.
So if the U.S. could go a little faster, and with Adrian's help,
Here's the problem. The Washington alphabet soup, I don't hold too much promise for. So Adrian, it's all in your hands. You got to drive it from New York.
but if you know, so I think it's really important for the U.S. to get this right because of the dollar as a reserve currency. If the U.S. doesn't get it right, then you don't really have a really good solution, frankly.
What do you think?
Incidentally, interesting to know that you think Basel is European. So,
It's less European than it used to be. If you look at the composition of the board, it's a little bit less
What
European.
we bankers call Basel IV. The Americans still haven't signed up for it. And after Randy Qualls moved on, it's not clear how much they're going to. Half of the UK wants to exit it already. The rest of the world, actually, the Asians are not the rule setters, but they're the rule takers, and we jump on board. So it's all over the place, actually. But do you agree with that? That we need to, maybe FSB, maybe putting it on this thing, or is there some other opportunity to drive global consensus?
we need to. We need to. Probably G20 is the right body, FSB and so on, or Basel. It doesn't really matter. I mean, in fact, we have to all agree that, all regulators tend to need to think alike, and therefore, whichever is the ideal, institution or body to do that. What is essential is that there has to be a global understanding of how we need to regulate this space.
I have a provocative question for you. So, is it in America's interest that there is no global cooperation on building consensus on crypto policies, since most of private crypto capital and effort is anyway driven and made in the USA?
I don't think that's true. I really don't think that's true. Just given what you've seen over the last 6 months in terms of problems in this space, and the fact that we still have stablecoins that are pretty significant in size, that are pretty lightly regulated still at this point. So I do think that, when this space wasn't very big, you didn't really worry about the financial stability risk because, if it collapsed, then a few people would be hurt, but it wouldn't be big enough or broad enough to have huge consequences for the global economy. But as it gets larger and larger, I think the financial stability risks are becoming more potentially acute. And you look at the collapse of Terra and Luna this last year. It wasn't such a big deal in the United States, but like Korea, there were a lot of money in Korea that was invested in that algorithmic stablecoin, and people took really tens of billions of dollars of losses. So it's pretty significant.
Piyush, I think that if there is one thing that global sector really need to come together urgently would be green financing, sustainable financing, because it's everyone business, it's everyone problem regardless. But when it comes to crypto, I think context matter, and we may not have a global rules or standards, but a regional one would work, a national one would as well work. But I think what we need a global standard setter to do is on the green financing, the ESG financing. It is a mess, and everyone keep thinking about this as an asset class, and it's really annoyed me because a lot of the people in developing countries, Cambodia in particular, we suffer a lot from this, and we don't get enough financing going into our country because there is this particular standard, there's this rating we have to follow, such and such, and it's not, it's not a time to look into it as an asset class where the investor is making money or not. It's not a time to look at the market mechanism. It's time, it's an existential questions that everyone need to come together.
I agree with you. I think we're making progress. I think the International Sustainability Standards Board is a big step in the right direction if they come up with some reports. And I would agree with you. I think it's a big issue, but I think we're edging forward more on the standards around green and sustainability than we are on the standards of digital currencies and crypto. So I think the big large bodies of work. All right, I have 3-4 minutes, and so Bill has promised. I'm going to take you back to your old hat because I think it's of tremendous interest to the audience here. So, since you've been through this whole thing, if you were still on the FOMC, how would you be thinking about the issues right now around inflation? Is it sticky, not sticky? Where's the data telling you? And therefore, do you need to do what Walker did and take rates forever and higher, or is there a level beyond which you start balancing the employment and inflation twin agendas? And the second part of the question is, has the US Fed, FOMC, started adding the third dimension to their mandate, which is financial system stability?
So let me take the financial stability question first, then we'll go pivot back to monetary policy. I think at this point, the financial stability worries are pretty low because of all the changes that were implemented following the great financial crisis in terms of the core banking system, liquidity, capital, stress testing, much bigger focus on governance, data management, risk. So I think the core banking system is in much better shape, number one. Number two, the balance sheets of households and businesses is in a totally different place, speaking in the United States, compared to what it was back in 2007, when we had this huge housing bubble that was resting on a very fragile set of financial engineering, and we saw how vulnerable that was. So I don't think financial stability is really front and center in terms of the Federal Reserve's thinking at this point.
But sorry, my thing is, suppose the market's crashing, or suppose something happens like the UK gilts.
Yeah, I mean,
do central banks still think about we need to step in to stabilize?
Well, I mean, look, if the U.S. Treasury market, became dysfunctional like it was in March of 2020 when the pandemic hit, I'm sure the Fed would intervene to try to ensure good market function. That's not something that we expect to happen, but the central bank is essentially the liquidity provider of last resort, and if that was necessary, I think the Fed would intervene. I don't think the U.S. is in a UK kind of situation. I mean, a couple of really important differences from the UK. First, you need a very bad fiscal proposal that people think could actually pass. If the Biden administration had made that fiscal proposal, people would just laughed it off. And so
you might get Trump again. You never know what happens after that.
Well, that's 2 years down the road, at least. So number one. Number two, the U.S. pension system is not engaged in this kind of liability-driven investing to the same degree, and it's a much smaller share of U.S. financial assets relative to the UK pension systems. So it seems to me like that's a low risk. That said, there is residual concern about the U.S. Treasury market in the United States because the size of the Treasury market has grown very, very fast, and the size of the balance sheets of the primary dealer community to support that market has not grown commensurately, and there's a lot more liquidity and capital requirements that they're wrestling with. So this is an ongoing issue in the U.S. is just to keep an eye on the Treasury market function and make sure that there's a number of proposals in place that are moving forward. We'll see the Federal Reserve Bank of New York is hosting a conference this week that I'm missing, which is a little bit painful to me. But then we're going to sort of see what's actually going on in that space. Now, turning back to monetary policy, we're not at the Volcker situation at all yet. This is like the early 70s, not the late 1970s, for a really important reason. Inflation expectations are still really quite well anchored. So, when Volcker came in, people were expecting inflation to be 7, 8, 9% forever, and that's what forced Volcker to follow such an austere regime. Jay Powell doesn't want to end up like Paul Volcker, so he wants to take enough medicine today so the inflation expectations don't become an anchor, so he doesn't have to do something really, really harsh later. I think the Federal Reserve, was very slow off the mark in terms of tightening monetary policy. The reason why we've gotten 4 75 basis point hikes in a row is because the Fed's catching up. But now the Fed is actually at a tight monetary policy regime. And so the strategy from this point is they're going to go a little bit further, probably take us to 5% or a bit more, and then hold rates at that level and let what they've judged to be a restrictive monetary policy gradually slow the U.S. economy down, drive up the unemployment rate, and gradually push inflation down. This argument about inflation transitory, non-transitory, it's both. There's transitory elements like used car prices, but there's also pieces that are much more persistent. And so this one or the other, I think, is wrong. The problem we have in the U.S. today is that underlying inflation is running somewhere between 4 and 6%, depending on what measure you look at. And number two, the U.S. labor market is way too tight to be consistent with 2% inflation in the future. So the Fed essentially has to tighten monetary policy enough to slow down the economy sufficiently to generate enough slack in the labor market to push inflation back down to 2%. And that's going to be painful. And it's going to take some time. And so we're at the very beginning of that mission. The Fed actually hasn't accomplished anything yet in terms of loosening up the labor market. The last payroll employment report we got on Friday, 263,000. That's not consistent with a loosening labor market. So there's a lot of work to come. And unfortunately, this is going to put a lot of pain on the rest of the world, because as the Fed tightens, the dollar appreciates. That puts more pressure on other emerging market economies, especially those who've taken on a lot of dollar debt. I think the Fed's reaction to all this is really very sorry that we're causing all the pain for you. But we have to take care of our core problem, which is U.S. inflation, getting it back down to 2%.
Well, just last question before I wind up. So the conventional wisdom has been that, in fact, it's not wisdom. The 2% inflation rate has been talked about, and therefore an accompanying roughly 2% neutral rate is what people have expected. Is it possible that the Fed shifts and say going forward maybe a 3% and 3% handle is more like neutral and the new norm?
Well, the reason why you'd like to have a little bit more higher inflation rate target is because then you would have a higher level of short-term rates in normal times, and then you'd have more room to cut rates when you actually were in a recession. I mean, the big fear about 2% inflation target is that short-term rates are not that high at the end of the cycle. So you have a recession, you get pushed back to zero, and you worry about a Japanese-style outcome. I don't think the Fed's going to change their target anytime soon. I mean, it's not credibility enhancing to move the goalpost when you can't achieve the objective. So I think people, if the Fed tomorrow said, oh, never mind, we're not going to do 2%, we're going to do 3%, people would view that as not credibility enhancing. I think that'd be credibility destroying. So, it's being debated. Jason Furman is a very good economist, has talked about 3% inflation target. Other people will talk about it as well. But it's also important to recognize in the United States is the mandate for the Fed comes from Congress. And what Congress says is, this is the Humphrey-Hawkins Act passed in 1978, maximum sustainable employment consistent with price stability. The Fed has stretched the notion of price stability to 2% inflation. Can you stretch the definition of price stability to 3% inflation? Maybe, maybe not.
All right, thank you. On that note, we're going to wind up. Mohanty, you heard from all of these folks about why private money makes no sense. So I'm going to leave it to you on the next panel, at least some of them, to get the rest of the practitioners to explain why they think it does make sense. So on that note, ladies and gentlemen, please join me in a big round of applause. Thank you. This is a great panel.